morning, everybody. Welcome to our weekly Multifamily Investor Nation webinar. I am Andrew Davis. I'm very happy to be here with you all this morning. I'll let people kind of trickle in here. Good to see you all. The topic today is investor call fundamentals. And I'm going to dive into that in just a second, talk about how to have a really dynamic and impactful initial call with a prospective investor. Before I do that, I want to bring your attention to a couple things here. I'm going to share my screen as you may know, I am the Director of Investor Relations for PassiveInvesting.com. And we are a commercial real estate private equity group. And one of the reasons that I'm here talking to you about this topic today is because we have raised over almost $500 million now since we started in 2018 to acquire well over $1 billion in assets. This $1.2 billion here does not factor in our dispositions or the assets that we've exited. We have now, going to update this, over 1,800 investors, and then across different asset classes, well over 4,000 doors under management when we factor in our self-storage portfolio as well. So if you're interested in learning more about us and seeing how we put deals together and seeing investment opportunities, just click that little Join the Passive Investor Club link at the top right-hand corner of the screen there. Fill out this very easy application and someone from our team will reach out to you to have an introductory call. And then in addition to that, I want to talk to you about MFIN Con 2023. So we had a really fantastic Multifamily Investor Nation live conference in Charlotte last month, and next year is going to be even better. And so we have early registration right now. So tickets are pretty discounted relative to what they'll be leading up to the event. And we have already locked in Alex Rodriguez, and we're talking to two other incredible speakers, one of whom I am very, very excited about, in addition to A-Rod, of course. But it's a great event, tons of opportunities to network with other capital raisers, to get just a good state of the market and really grow wherever you're looking to grow in the multifamily space. So without further ado, I'm going to stop sharing my screen and just have a conversation with you. So I don't have a big presentation or anything. I love to be interactive. I know it's a little bit more challenging here on a webinar, but I am monitoring the chat box. And so if you have questions as I'm talking or something comes up, just shoot me a note and I'll do my very best to answer it. So investor call fundamentals are what you need to know going into an introductory call with an investor. So this would be somebody that has been referred to you or has come in through one of your inbound lead platforms, and you're having that introductory call with them. And so since I have been in this investor relations capital raising role, I've had probably about 2,500 calls with potential LPs or passive investors. And so I've learned a few things, as you might imagine. And so, one of the, there's really kind of couple components to it, right? There is you and your preparation for that call going into it. There's the actual call itself, and then there's the follow-up. And so, going into that call, really what you need to know are a couple things from a mindset perspective. Number one, if you haven't done a lot of these, if you're aspiring to, be really confident and comfortable on the phone, one thing you need to know is that if you have any baseline knowledge about multifamily real estate investing, et cetera, then you're likely going to be an authority, depending on who your investor avatar is. For us, our typical LPs are, highly paid, highly educated professionals. So we're talking doctors, lawyers, engineers, executives, et cetera. That makes up a very large percentage of our LP base. And so these are people that are highly educated, very successful in their field, but don't necessarily have a ton of knowledge about the nuances of multifamily investing and markets and economies and interest rates, et cetera. And so I think a lot of people come in with a mindset of, hey, I'm going to be talking to some, institutional guy, and they're going to ask me a bunch of gotcha questions, and I'm going to look stupid. And, Maybe, but in my experience over those 2,500 calls, depending on who you're targeting as your key investor, but if you're targeting individual retail investors, then likely you are going to be more well-informed than they are, which does not give you an excuse not to be prepared or educate yourself, but just know that going in that, hey, you're going to be giving them a lot of great information. And then sure, they may ask you a question you don't know the answer to, and that's okay. I don't know, let me find out for you is a perfectly acceptable answer. So that should take some of the pressure off as you're entering into that call. And then really what you want to know going into that call is, investors are going to have a list of questions that they want to get through. And that's going to depend on their experience. It's going to depend on their goals, and it's going to depend on their personality type. So you have very, very analytical people, and they may have very, very detailed questions about the returns and the structure. And we have sometimes people that in their spare time, they like to read through the 170-page PPM and find errors or ask very specific questions about legal language. That's the anomaly. But your average investor is going to have some very basic questions about your track record, about your returns, about your strategy, maybe in this current economic climate, about how you're positioned or how you're hedged against a recession type event, what your debt terms look like, what kind of margin of safety you built in, et cetera. But basically, they're going to want to know, why you've, landed on this asset, how you plan to operate, what's your plan, and how you're going to grow their capital. And the underlying questions beneath all those questions are really two. And generally, an investor will never ask you this directly. I don't think anybody ever has, but they're going to want to know if you're trustworthy and if you're competent. So trustworthy should be a given, right? If somebody's going to give you $100,000, $200,000, $25,000, $1 million, you need to be trustworthy. They're effectively, especially if they're an LP or a passive investor, which in this case they would be, they're basically giving you control of their finances and allocating a portion of their financial future to you. And so you can't fake that. You just have to be that, and that's pretty straightforward and self-explanatory. The other question is, are you competent? And really, what they want to know is, hey, are you gonna do a good job with my money? Have you underwritten this deal well? Do you have good asset managers and property managers in place? Do you have good communications systems in place? Are all your T's crossed and your I's dotted? And really, the way that you can communicate and demonstrate about that is coming into that call being very, very knowledgeable. You don't have to know everything, but you should know, hey, the basic fundamentals of your strategy. If you're not one of the principals, you should know the backgrounds and the bios of your principals and why they're qualified to do what they're doing. You should know about all the different opportunities you have, what the fundamentals of those are. It's okay to have a cheat sheet out in front of you, but you should be prepared to ask or to be asked and answer some of those basic investor questions. What's your track record? What have you ever lost money? Have you ever done a capital call? What's been your returns? Those sorts of things. So really having a good baseline knowledge and understanding of your strategy, of your opportunities, of how you're positioned to navigate a recessionary environment. Those are all questions that you're going to get asked. And so really, when you go into that conversation, what you want to do is really make it about the investor. So I'm sure we've all heard the expression, God gave you two ears and one mouth for a reason. And so really what you want to do is that's an exploratory call for you. So from the very moment you get on the call with that investor, you want to be getting to know them, and you want to get to know them because you should ideally care about this person, right? It's a business relationship. They're a partner with you. If they're going to invest with you, they're going to be invested with you for potentially, the life of your business. That's certainly our goal, is to build a legacy business where investors will invest with us over and over again. And so you want to get to know them, find out what their goals are, find out what their why is, and really make sure that what you're doing is a good fit for that, and then be able to speak to why it's a good fit for that. You also want to pay attention in that kind of initial conversation that you're having. And so basically the way that we structure these calls is call them, do a quick kind of intro. Hey, it's Andrew. Want to set some basic expectations for the call about how long it's going to take. And then really it's going into who are they? What do they do for work? What's their real estate investing experience? What are their goals? And then from there, that can really inform where you take the call. But again, you want to be talking less, listening more, and really listening for really listening for their pain points, or if they're not pain points, the things that are really important and valuable to them. And then you want to make sure that you're gearing that time, your time, to addressing their concerns, their questions, their unknowns. Because one of the things that can happen when you're in this space for a very, very long time, or you've had a lot of these conversations, or it becomes kind of old hat to you, is you can fall into a pattern or a bad habit of just talking about what you know, right? You can just kind of dive into a script, for lack of a better term, or let me tell you about our track record, whatever it may be, and that may not be the question that they're asking. So really understanding what their pain points are, what is of concern to them, and making sure that you address that in the conversation. And really the way the flow of the conversation works is once you've had that intro, once you've gathered as much information as you can about them, usually from there, my team will lead into what we call the hits. And what we want to hit in there, hits in the hits, is we want to spend a good chunk of time talking about who. And the reason for that being, as I mentioned earlier, is when somebody's investing with you, yeah, they're investing in a project, but they're really investing with you. There's a lot of projects out there. There's a lot of operators out there. They're choosing you because they trust you. And so what you want to do is spend time talking about who you are, who your team is, who's in your company. So for us, we spend probably, if that kind of 2.5 minutes of an elevator pitch or an overall intro of our company, we're spending probably half of that time talking about the managing partners, talking about the team that is acquiring and managing and improving these assets. And the rest of the time, we're going to talk about the track record. I'm going to make sure that this investor knows that, hey, we've got over 1.2 billion in assets under management. We have over 1,800 investors invested with us, and about 70% of those are repeat investors, are invested in multiple assets with us. I'm going to make sure they know what types of assets we buy, what markets we buy them in, and then why we've landed on that strategy. And then I'm going to make sure that they know too how we're positioned to move forward in this current environment, right? How we've diversified across different asset classes and types. And really my goal in that is to give them a lot of information and then to address a lot of those kind of low-hanging fruit questions. And so in that 15 to 20 minute time after I've given them that elevator pitch or spiel, hopefully I've answered 80% of their questions about our track record, or have we lost money, or tell me about the principles, whatever it is. They're all great questions, but then that really lets us get to the meat in either talking about a specific opportunity, about deep diving any specific questions they have, about identifying any additional resources that may be helpful to them as we wrap up the call. And more often than not, when we finish up a call, I'm sending a pretty comprehensive follow-up email. And so basically, at the end of that 15 to 20 minute time, I want to make sure I've answered all their questions. If I have more time, I'll take it. Generally, what I do is I encourage them to schedule a follow-up call, or we'll set up a time to have a follow-up call if they want more information. However, I can probably count on two hands the number of times that has happened. And so giving them resources ahead of the call with our email marketing efforts and all the information we have on our website, giving them a ton of value on the call, and then sending them a lot of follow-up information afterwards usually satisfies most people's curiosity. But basically what I do when I wrap up that call is I want to make sure I get a few key pieces of information from them. One of them being their mailing address. We send out should have a copy around here somewhere. We send out a monthly newsletter. We also send out our physical printed newsletter. We also send out our offering memorandums in the mail as well. So I want to make sure that we are having those touch points with them. We used to work as a residential real estate agent, which was not for me, but that's another story. For Keller Williams has an unbelievable training program for new agents. And one of the systems they have internally is called a 33 touch. Basically, the idea is that if you've got someone in your database, you want them to hear from you 33 times in a year. So that can be calls, that can be emails, that can be texts, that can be physical mail, whatever it may be, right? But we want to make sure that we are crossing people's field of vision or attention or thoughts on a regular basis, and giving that mailing address allows us to do that. The other thing I do is I set expectations as we wrap up the call. And so I make sure that they know what they can expect from us in terms of deal flow. I let them know that I'm going to be sending them a bunch of follow-up information via email based on our conversation. And if there's any, of course, I have a template that we use that is a template email that I can just click and it fills in. But oftentimes I'm going to modify that. I'm going to send some additional resources or a link or something like that based on what we discussed. I'm going to get their mailing address, and then I'm going to send them a recent copy of a newsletter or an offering memorandum, ideally both, so they get that in their mail within the next week. And then I am going to send them a text message when we get off the call with my contact card. And it's going to say something to the effect of, hey, really enjoyed talking to you. Reach out anytime. And I have sent that text message out well over 2,000 times. And, for those of you that are introverts or are afraid about your phone blowing up with text, I would say maybe 1% to 2% of our investors text me on even a semi-regular basis. And quite honestly, I want them to be able to. We have had a tremendous amount of success, raised a ton of money, have this unbelievable network of passive investors that are partnered with us. But one of the key things that I really encourage my team or encourage anybody that is going to be investor facing and raising capital is, when you're having that conversation, it's very easy when you talk about raising $18 million or having $1.2 billion in assets under management. When you use these big numbers, it's very easy to think about a $25 or $50 or $100,000 investor as not insignificant by any means, but just to not to give their investment and their decision to invest with you the proper amount of respect and attention it deserves. And for most of our investors and for the majority of the world, $50 or $100,000 is a tremendous amount of money. So really making sure that in that conversation that I am present and patient with them, answering their questions, whether they're going to invest $25,000 or $50,000 or whether they're going to invest $5 million. My team and I really endeavor to treat every single person the same. And that's really the essence of it. At the end of the day, you're having a conversation with somebody, you're addressing their concerns. One of the key things that we try to do is tell stories. People resonate with and remember stories much more than they just do facts. And so if somebody asks us about, hey, have you ever done a capital call, rather than just saying no, which is correct, we haven't. But I'm going to talk a little bit about why that is and about some of the things that we built in place and why we built those things into place. Or, tell me about a deal that went south. Well, we've never had a deal that really went south, but I have a great, example of a deal where we overestimated the rent increases that we could achieve based on our renovation plan. We had to dial that back. And so, knowing those, those stories that resonate with people and communicate your values as an organization and how you're approaching the business are very, very impactful in those conversations. So I think that is about all I have for you all today. I don't see any questions, but I'm open to answer any questions you have, either about the investor call process or anything else that we're doing at passiveinvesting.com. If you'd like to drop a note in the chat or send a Q&A. But if not, has been great to be here. Oh, I'll put it in the chat. So somebody just asked me what my email is. You can just reach me at andrew@passiveinvesting.com, hosts and panelists. Boom. There we go. Got it in there from two people. That's my email. Reach out to me anytime. Are there any templates you can send for an example to get the idea? Oh, do you mean a follow-up email template? Sure, Lenny. If you send me an email, I'll send you the follow-up template that I send to investors after we get off the call with them. Just andrew@passiveinvesting.com. And when would a capital call be appropriate? When you need the money. So I would say that a capital call is never appropriate. Well, I guess it depends on what you mean by appropriate. It's never ideal. You never, as a sponsor or as a GP, want to go back to your investors and say, hey, we need more money. Now, Does that happen? Absolutely, it does. It tends to happen. You hear about it a lot with development projects, right, where things go way over budget. But for existing, if you're looking at, say, acquiring an existing apartment building, if you've underwritten that properly, if you've built in the proper amount of reserves, if you've built in the proper amount of capex for any renovations that you need to do, if you have stress tested that asset we stress test down to about 60%, which basically means that we can get down to 60% economic occupancy and still meet all of our operating expense as well as debt service obligations. So if you're doing all those things, the likelihood that you're going to have a capital call is very, very low. So a capital call is appropriate, right? As soon as you know that it is necessary, right? So you certainly don't want to delay. So if there is capital necessary, you want to be one of our really values, prime or core values at passiveinvesting.com is communication. And so usually that's good communication. Hey, you're going to get your distribution as usual this month, or you've got a new opportunity, or we're selling this deal and you're going to have a 26% IRR, whatever it may be. But conversely, we also, we had to send out a closing delay email today on one of our assets, and nobody wants that. We don't like to hear that. It's a lender delay. It doesn't have anything to do with us. But really, a capital call is never ideal. But if for some reason you have to make one, make it quickly to be as honest and transparent with your investors as possible. What does your follow-up process look like? The cadence, approach, and certain content. So Lenny, for us, this is something really that what we do is we're really building out the IR team. And so what we have basically is we have investors that are assigned to somebody on the investor relations team based on their geography. And then we're making sure that we're just communicating with them on a regular basis. And so they kind of get put into a bucket after a call, right? We want to track how engaged are they with our content, when, have they invested? And then basically for us, it's going to get drilled down to individuals, right? And so we want to make sure that for investors that are continuing to engage with our content but haven't engaged yet, that we're interacting with them, dropping them a text, email, seeing if they have any follow-up questions, see if there's any additional resources that we can provide to them for our investors that are very, very consistent and engaged. And this is looks like another question from Irish Kevin. 70% is the repeat investor ratio. So roughly 70% of our investors are repeat investors in multiple deals with us. Right now, we use ActiveCampaign for a CRM, and that works well. We're always exploring other options, but that's really how we approach that. I mean, one of the things that we want to make sure is, hey, not only are we getting new leads into the database, but then also are we making sure that those investors that are coming in are getting the information and the connection that they need to make an informed decision about investing with us. So that's how we do that. How do you handle investors that may need to get out of an existing deal? So this happens very, very, very rarely. It is a question that you'll get asked from potential LPs from time to time. The first thing that everybody needs to know is that when you're investing in a syndication, you are investing in an illiquid. It's an illiquid investment in real property, and there's no secondary market for those shares. And that's just our fancy legal way of saying, hey, this isn't the stock market. You can't get out the next day. However, if somebody does have an urgent capital need and they need to get their capital out of one of our assets, then we have effectively a 3-part process. The first part of that process is, or step 1, is that all the other LPs in that asset are notified that somebody wants to sell or get out of that deal, and then they all are kind of offered the opportunity to buy that investor out. Usually that's where it lands. If not, the managing partners can buy them out, or the asset itself, if it's performing, to pro forma, can buy them out. So those are the options there. And then I want to make sure I hit all these. Open, done. Great. Well, I think I got everybody. If I didn't, feel free to send me an email. I'd be happy to answer any follow-up. Oh, let's see. I'm asking because the commercial Howard enough due diligence and returns are not being issued because of that. So instead of using investor returns to buy a new roof. So the question is, Kevin's in a deal and looks like a roof needs to be replaced. It wasn't, correct me if I'm wrong, Kevin, but just kind of reading through what you said here, looks like they did not raise enough CapEx dollars to cover that. So in lieu of issuing cash flows, they're basically holding cash flows they're basically holding cash flows in order to take care of that roof, the cost of replacing that roof. And so your suggestion, Kevin, or what you're saying is possibilities. Instead of using investor returns to buy the new roof, you could issue a capital call. That's true. I think people would rather have a reduction or a temporary pause in distributions than having to come up with an additional investment. Because especially if the operator has structured that deal well with a preferred return, then those cash flows or those returns are not disappearing, they're accruing. So if you've got a cumulative preferred return structure within that deal, then even though you don't get those monthly or quarterly distributions, depending on the frequency with which they're being distributed, they should be being accrued for you and should be paid out as the performance of the asset increases once the roof is done or at exit or refinance. So answered that live, which takes several years. Yes, I agree. It's really up to the operator in terms of what they think is a better strategy, whether it's a capital call or pausing distributions. And then the last question, and then I got to jump. If LPs or GPs buy out another LP investor, is the price negotiated or is the price set at a dollar for dollar nominal exchange? No, Rogelio, the price is negotiated. And so, this is a real kind of classic negotiation scenario where the LP that needs to get out is the one that's not necessarily in the power position and the one that's buying them out is. And so usually the person that is buying out the LP is going to negotiate a discounted price for those shares. So thank you all so much. Always enjoy these. Thank you for the questions and the dialogue. You have my email, andrew@passiveinvesting.com. Again, Multifamily Investor Nation, MFINCon 2023 is coming up here in June. This last one was really tremendous in terms of the speakers, in terms of the networking, I think in terms of the value that everybody got out of it. So would hope to see many of you there next year in 2023. Andrew at passiveinvesting.com. Hope you all have a tremendous Tuesday.